Hey everyone, welcome to part 2 of Investing for Retirement. So at the end of part 1, we left off with an example of defining and quantifying retirement goals. And in this video, I'm going to finish that example by taking you through the rest of the steps and show you how to put together a realistic retirement plan. Hey everyone, this is Michael Tortorich and thanks for tuning in. Just a quick note in the video before we get started. These videos are designed to complement my book, Running the Numbers, a step-by-step guide to life's major financial decisions. Each video corresponds to a chapter or a section in the book, and the idea is to review the chapters and use these videos as a platform to add some additional color around the examples where it just wasn't really practical to do in the book. So to check out the book or additional videos, please visit my website at michaeltortorichfinance.com, and there's also a link to the website and the book in the description below. So we left off in part 1 after we had identified our hypothetical couple, Jason and Sarah's retirement goal. And after we ran the numbers, we defined that as being able to generate just over $66,000 a year in passive income. And in this video, we're going to continue to step 2 and identify their investor type. We're also going to look at a range of investments and the potential returns depending on different levels of risk. And then we're going to put it all together to sanity check and prioritize their retirement goals. And then lastly, we're going to review what to expect when looking for help from an investment professional. So let's go ahead and jump into step 2, which is understanding your investor type. And this step has 2 components, which are understanding your willingness and then ability to bear risk. So Jason and Sarah are cautious investors. They have no previous investment experience and are willing to take a medium to low risk. Also, they only have $75,000 to invest, so they can't really handle a large loss to their portfolio either. And as such, their risk tolerance or willingness to bear risk and their ability to bear risk is going to be medium to low. Now, the next question is, based on a medium to low risk tolerance and ability to bear risk, what type of investments should the couple be looking at and what types of returns should they expect? So now let's take a look at some common investments and their potential returns, and we're going to look at these in order of lowest to highest risk. Starting with the lowest risk return category, the first investment is a certificate of deposit, and it's also known as a CD. And this is a time-based deposit account. So typically, when you deposit money in a bank, it's deposited as an on-demand deposit. In other words, you can withdraw the money out whenever you want. With a time-based deposit, you agree to lock up your money for some period of time, and in return for that, the bank gives you a higher interest rate. And this lockup period can range anywhere from 3 months to 10 years, and the rates normally range from about 1% to around 3%, and that's just going to depend on the bank, the length of time that you're willing to lock it up, and also the amount that you're willing to lock up. And CDs are offered by most all banks, and as long as your bank is insured by the Federal Deposit Insurance Corporation, or it's otherwise known as the FDIC, your deposits are going to be covered against any kind of insolvency for up to $250,000. And if you want to get more detail on the types of CDs out there and their current rates, you can actually just search in Google for Investopedia Best CD Rates. And if you go to the Investopedia website, they have a great up-to-date summary of the best CD rates across the United States. And if you just scroll down a little bit, you can see that they give you the banks with the best CD rates by term, starting with 3 months and then going all the way down to 10 years. The next investment in the low risk, low return category is U.S. government debt. And these are bonds issued by the U.S. Treasury and are generally considered risk-free. Now, these bonds come in a range of time horizons, anywhere from 1 week all the way out to 30 years, and depending on the time horizon, the interest rate you receive will typically range from around 0.1% for the really short time horizons to around 3% for time horizons closer to 30 years. Now we'll move to the medium risk, medium return category, and the first investment here is the S&P 500 Index Fund. Now, according to Investopedia, the S&P 500 had an average return of approximately 10% per year since its inception through 2019. So, as you can see, as you move into the higher risk category, your potential returns also increase. But keep in mind that that 10% is just a historical average and shouldn't be taken as a guarantee of future returns. And as I'm recording this, it's July of 2022, the S&P is down about 13% on the year. So if you had invested in the S&P on January 1 of 2022, you'd have lost about 13% of your money so far this year. So in any given year, the return can be negative, higher, or lower than 10%. However, over the long term, the S&P 500 has trended upwards and will likely continue to do so, but again, over the long term. The next investment in the medium risk, medium return category is a market-specific fund. And a market-specific fund is an investment fund that tracks a specific subsection of the market. And the more concentrated the fund is, the more potential risk, and the return will increase. So now let's actually jump to Vanguard's website and take a look at some of the funds that they offer. And I chose Vanguard as an example for two reasons. The first is because the funds they offer are pretty representative, and Vanguard really gives you a good idea of the types of funds that you're going to be able to invest in really through any brokerage or investment advisor that you're going to go to. The second reason is that Vanguard has the lowest fees in the industry. And if you remember back to the video from Chapter 7, it's always in the best interest of the investor to keep those management fees to a minimum. So here you can see Vanguard has a really broad selection of stock funds ranging from US large cap, and then with that they've also got dividend and growth focused funds. They've got mid cap and small cap. They also have international funds and also sector focused funds such as communication, consumer discretionary, etc. So again, this is going to give you a very good idea of what's out there and what you're going to be able to invest in. And the average 10-year annual returns for Vanguard funds ranges from about 1% to just under 20%. So just to give an example, if you had invested in the information technology ETF, over the past 10 years, you would have averaged just under a 20% return per year. But 2022 year to date, you can see this fund is down 20%. So again, you have the potential for higher returns the more concentrated you go, but as I mentioned before, always keep in mind the historical return should never be taken as a guarantee of future returns. The last category is the high risk, high reward category. And the first type of investment in this section is investing in individual companies, either through their stock or their corporate bonds. Investing in specific securities requires a significant amount of research and due diligence, and it's considerably more volatile. In other words, you have the potential for 100% losses all the way to 100% and above returns, and that's just due to that concentration of risk. The last investment option, and by far the riskiest, is derivatives. And derivatives are trading instruments that get their value based on the performance of some other asset. And some examples of derivatives are options. So for example, you have puts and calls. There are also swaps, swaptions, futures, forward contracts, and the list goes on. Now, if you've never heard of any of these terms before, or if they sound really confusing to you, that's okay, because derivatives are very confusing, and they can also be extremely volatile. In other words, they have the potential for greater than 100% loss to greater than 100% gain. Now, the specifics of derivatives are beyond the scope of the book and this video, but if you're interested in learning more, I'd recommend just Googling Investopedia Derivatives 101, and Investopedia has a great primer that will teach you the basic terms, types of derivatives, etc. So let's assume our hypothetical couple, Jason and Sarah, look through all these options, and as they are medium to low risk investors, they choose an appropriate mix of investments to reflect that, and their portfolio is projected to yield a return of 6% per year. So now that we have an expected return, we can calculate the portfolio amount required to generate the $66,276 per year in passive income. And we do this by simply dividing the $66,276 by 6%, which is $1,104,600. Next, what we can do is test how realistic this goal is by seeing how much they're going to end up with in 15 years, or when they plan to retire, if they save all their disposable income every year. And we can do this by using the future value function in Excel. So let's actually jump to Excel and take a look at how to do that. So here you can see we're on the Future Value of Investment tab, and this file can be found on my website, michaeltoteridgefinance.com. And starting in the top left, you can see our assumptions. The return on investment is 6%. The yearly amount to invest is $30,000, or their disposable income of $2,500 per month times 12 months. Their initial investment is $75,000, and this represents how much cash they have currently to invest. And then lastly, the time until retirement is 15 years. So if we take a look at the future value formula, you can see the first input, it asks you for the rate, which is 6% per year. Next is the NPER, or the number of periods, and this is 15 because they're going to retire in 15 years. The next input is the PMT, or the payment, and this is a negative $30,000 because that's the amount that they're going to invest every year. Next is the PV, or the present value, and this is negative $75,000 because this is the cash that they have on hand to invest today. And then lastly, the type, this is always 0 because we assume they're going to invest at the end of the period. And so if we hit enter, this tells us that at their current savings rate, with a forecasted return of 6%, they're only going to end up with about $878,000 when they retire. And this is not going to be enough to meet their primary retirement goal. So now what we want to do is, let's see how much they would need to save each year at their assumed portfolio rate of return of 6% to meet their retirement goal. And we can do this by using the PMT, or payment formula, in Excel. So let's jump back to Excel again and take a look at how to do that. And you can see again we're on the Future Value of Investment tab, and starting with the assumptions, we have a rate of return of 6%. The years into retirement are 15. The present value of their investment is $75,000, and again, that's because that's how much cash they have on hand today to invest. And the future value of their investment, and this is their portfolio goal, is going to be $1,104,600. And so if we use the PMT function and input those assumptions, we'll first input the rate, which is 6%, then the number of periods, which is 15, then the present value, which is $75,000, then the future value, which is $1,104,600, and then lastly the type, which is 0. And you can see they would need to save $55,179 per year as compared to the $30K they're currently able to save to get to their portfolio value of $1,104,600. So at this point, Jason and Sarah need to reassess their assumptions and/or their goal, because their current goal is just not realistic given the amount they can save and their ability and willingness to bear risk. And the couple actually still has a few options that they can use to still try to meet their retirement goal. So first, they could delay retirement, and this will allow them not only to save more, but will also give their investments more time to grow. They could also increase their yearly savings, and they could do this by either decreasing their monthly expenses, which would in turn increase their disposable income, or they could take on a second job to generate some additional income to invest. The other thing they could do is lower their retirement income needs, and they can do this by either lowering their retirement standard of living or retire to a cheaper location. So for example, retiring somewhere abroad where they can maintain that same standard of living but do so at a reduced cost. So one or any combination of these options can be used to meet their retirement goals. Now, it's going to be tough for Jason and Sarah to just meet their primary retirement goal, but if they still insist on paying for their daughter's college, that's their secondary goal, they should also look at some options such as sending their daughter to a cheaper college, or maybe delaying when their daughter starts college, again, to give their portfolio some more time to grow. Maybe they could have their daughter work to offset some of the expenses, etc. But for this example, let's assume they decide to forget paying for their kids' college and just focus on their primary goal of maintaining their current standard of living during retirement. So now that the couple has prioritized their goals and identified their risk tolerance and ability to bear risk, an investment advisor is going to be able to help them create a portfolio that is going to best meet their needs. And there's lots of different types of investment advisors out there, but broadly speaking, they should expect the following. And I'm going to go through these in order of the smallest to largest amounts of investable assets. The first is an algorithm-based advisor, and these are also known as Robo advisors. And this is for the lowest level of investable assets, so up until about $25,000. And what's going to happen is you'll likely complete an online survey specifying your investable assets, your goals, your risk tolerance, etc. And then based on your responses, a computer algorithm will recommend investments for you. And what this does is it helps the brokerages reduce costs and provide services that would otherwise be too costly for these smaller accounts. Next is an algorithm-based advisor with some degree of professional management. And the level of assets that you would need here is going to range from around $25,000 to $200,000. And the exact level of professional management is going to be different depending on your investable amount and the particular company that you use. But with this investment amount, you should expect some level of actual human involvement and oversight. The next is going to be a professionally managed custom portfolio. And for this level, you'll likely need assets of around $200,000 to $1 million. And at this level, there's going to be a dedicated wealth manager designing and looking after your specific portfolio. And then lastly, for $1 million and above, at this level, the big difference is really going to be the client to wealth manager ratio. And that's going to start to really decrease as the assets that you can invest increase. And here what you're going to get is also additional services personalized to you, such as tax, legal advice, estate planning, etc. Now again, the exact amounts required for investing and the level of service is going to differ based on the advisor you use, but for most financial services companies, so for example, you have E-Trade, Vanguard, TD Ameritrade, Fidelity, etc., they're going to offer advisory services, and I recommend just checking out their websites to get more information about their different offerings. So at this point, because the couple has gone through steps 1 and 2, they should be able to articulate their goals and risk preferences to a financial advisor. And regardless of what level of service they receive, that financial advisor is going to be able to put together a portfolio that best meets their return objective while also taking into consideration their risk tolerance. So that takes us to the end of the example and to the end of this video series. I want to end this video by saying that financial literacy is a journey, and by watching these videos or by reading the book, you've taken an important step on that journey. The topics I've covered are essential for everyday life, and developing an understanding of these ideas is going to set you on a path for future financial success. So I wish you the best, and thank you for letting me be a part of your financial journey.